Good evening. What a day it's turning out to be for the commodity markets. With Brent already at $80 to a barrel, there's a lot at play for crude. US will withdraw from the Iran nuclear deal following the announcement. Other signatories of the deal as well, including Europe, Russia and Iran, reiterated their support for the agreement as well as their desire to revisit it. As also rising geopolitical tension in other key oil-producing countries like Saudi Arabia and Venezuela create risk of additional production losses in the face of depleted inventory buffers. Morgan Stanley says the coming scramble for middle distillates raises oil forecast all the way to $90 a barrel. There is also talk on the street that we could touch 100. Goldman Sachs believes that their summer forecast of 82.5 is at risk and skewed to the upside. So over the next half an hour, let's understand the crude realities with our special panel, Oil on the Boil. Joining me today on the panel, Fatih Birol, Executive Director, International Energy Agency. Joining all the way from Paris, Michael Barry, Director of Research at FGE in London, joining in from London, and Jonathan Bharat, CIO, IS Alliance, all the way from Sydney. Vandana Hari, Founder and CEO at Vanda Insights, joining in from Singapore. Ladies and gentlemen, evening. Thanks so much for joining in on this very special edition. And Fatih Birol, if I could start off with you, what to your mind are the genuine factors responsible for this rally? I mean, we're at $80 to a barrel. That's near a 60% rise in the last 12 months. Do you see this kind of a surge sustainable?
Driven by, is today, by fundamentals. Demand is very strong. We have seen a very strong demand growth last year and this year. Plus, Venezuela, the production is falling down substantially. Only in 2 years of time, Venezuelan production is divided by 2, and we expect perhaps worse to come. And also, some key producing countries do not want to increase the production as they have a Vienna agreement, which also underlines the fundamentals of the oil markets today. So if there are some geopolitical developments on top of these tight markets, it may have further implications for the market in the next months to come.
If one were to watch out for, say, the next 12 to 24 months, would you be surprised if prices surged further to, say, even $90 or even $100 per barrel? Or is that stretching the argument a little too much, considering we're already at 80 and we're just talking about $20 more of an upside?
By law, I cannot say you anything about how the prices will be, what the number is. But what I can tell you, 2 things. One, I expect a lot of volatility in the oil markets. And the second, once again, higher prices are not good for the importers, exporters, and also for the global economy.
Michael, let me get you into the discussion, because the International Energy Agency in its statement just yesterday talked about Venezuelan oil output being the lowest since 1950s and having further room to fall. OECD stockpiles are already below the 5-year average, and the stockpiles drop persisting through second quarter and third quarter as well. How is it that you're viewing this scenario for oil?
Well, in terms of the last piece of information, the stocks, we certainly agree with that. We actually came out a month ago saying we thought that the stocks had fallen below the 5-year average at the end of March. And we're now estimating that end April, we've probably gone maybe 30 or 40 million barrels below that 5-year average. So the stocks position is very tight. And we see it getting tighter because we see no stock build in the second quarter overall. In fact, there might even be a slight stock draw.
But what about demand, Michael? Because the IEA is also cutting their 2018 growth forecast because of the surge in prices. With 80 already here, what's the next trend in oil demand?
In terms of the demand, we're slightly surprised by the reduction in demand because they've confirmed that first quarter demand has been very, very strong, growth of almost 2 million BD year on year. We do see it slowing down slightly in the rest of the year, but we do think actually the oil demand trend is very robust, partly because the oil exporters, of course, who are now quite a significant oil consuming group as well, are seeing a boom in their economies because of the high oil price. So we think that's offsetting the potential slight slowdown in the rest of the world.
Jonathan, it's a rather sharp upswing that we're seeing with Brent now crossing the $80 per barrel mark. What, according to you, are the factors at play?
Look, I think the market's a little bit concerned, obviously, with those macros that are at play at the moment, that we will see more of an issue coming on in terms of demand. I think, if anything, when you do look at what's happening, I think the market is a little bit concerned. We are seeing sort of more of the fund or the hot money moving in as well, and we're also starting to see some hedges. So I get a sense that the demand out there is really starting to push prices higher. And sadly or concerningly, I think it'll actually trade up through that US $80 a barrel.
Vandana, OPEC has already lifted the oil demand forecast amid rising prices, but also noted that sanctions, tariffs and the US withdrawal from the Iran nuke deal point to rising uncertainty over the global economic growth momentum. Seems like this uncertainty for crude is going to continue for some more time. What are your thoughts?
The upward revision in OPEC's demand forecast was minimal. I think overall they have been forecasting a strong demand growth for 2018. And for that matter, so has the IEA. So there aren't really that many differences of opinion on that. At the back of this, of course, the fear remains, or rather concern at this stage, that a rise in US interest rates and a parallel rise in oil prices could hit demand growth. But so that is something that I'm looking at very, very closely to see if we indeed do start seeing signs of a pullback in demand, especially in the emerging economies, countries like China and India, which are not only amongst the biggest consumers of oil, but also major drivers of demand growth. And so far from what we have seen, Chinese demand growth remains pretty strong this year. In fact, so far it seems to be doing even better than 2017, and so is the case with Indian demand. Now, that's not to say that it will remain necessarily the same pace of growth if prices, let's say, hypothetically, if they shoot above $80. So it's something that everyone will be keeping a very close eye on. From what I see now, I think the consensus in the market is that we are set for a strong demand growth here in 2018.
Michael, talking about demand, do you think that Venezuela-Iran shortfalls could be offset by higher US output?
Yes, we'd certainly agree with that. I mean, Venezuela is becoming a serious basket case, and production is falling pretty well every month. It's now 500,000 BD below their target level under the producer agreement. And we see maybe Venezuelan output falling to 1 million BD next year. Currently, it's about 1.5 million BD. Iran, obviously, it depends on the sanctions, but we actually think that the US is going to be very serious about applying the sanctions against oil buyers from Iran, probably more serious and stronger than the Obama administration was. In fact, there's already been some talk of the US telling European companies there will be no exemptions, whereas last time round there were, to some extent, exemptions and waivers. So I think they're going to take a much tougher line by the sounds of it, although we don't yet know all the details. But we think it could mean Iranian exports falling by over 1 million BD into next year. In other words, slightly more than was achieved under the Obama sanctions.
Fatih, how is it that you're analyzing the factors at play and the implications for commodity user economies like India, for instance? Because this crude uptake is taking a toll on inflation for us and sentimentally impacting the currency as well pretty hard.
First of all, looking at India, India is a growing economy, and it is one of the bright spots in the global economy today. And the growing economy needs energy, and as such, we see that India's oil consumption and also oil imports are growing very strongly. As of today, India imports about 4 million barrels per day of oil, and we expect this will increase in the next years to come. Around 2030, this will increase by almost a factor of 2, reaching above 7 million barrels per day. And this means India's import bill will also increase, and as such, a challenge for the trade balances. Our calculations on India shows that India, as of 2017, paid about 70 billion US dollar to import oil, and in 2030 this will go up to about 230 billion US dollar. And if the prices of oil goes higher and higher, of course this bill, this 230 billion, may be even higher than what we calculate today. And when we look at the global oil markets today, they are going some difficult times. Tightening of the markets is the name of the game. And when we look at the different factors today, what key producers do in order to increase the prices, the strong oil demand growth coming from China, India, and other countries, plus the political developments in Venezuela and elsewhere, tighten the markets, and as a result, we have today prices above 75 US dollars, which is, I think, not a good news for major oil importing countries such as India.
Vandana, sticking on the India subject, what growth do you foresee for Indian fuel demand in the coming months because of high fuel prices, given that India, like any other emerging market, has been a crude guzzling economy?
You know, something, a phenomenon that was observed back in the QE-fueled economic boom that we last saw was that the whole concept of demand elasticity seems to have been redefined somewhat. So we saw prices go up from post-financial crisis below 30 all the way to well above 100 and remained there for a few years during the economic expansion that was happening after the financial crisis, and demand growth wasn't really hit. So the assumption right now is that you know, these are countries that have shown, especially the ones in Asia, have shown strong demand growth even at crude prices above $100. Now, of course, we have to bear in mind that a lot of these countries, and quite prominently India, have actually removed their fuel subsidies since then. So some things have changed.
Right. Vandana, stay on with us. I'm going to take a very short commercial break. We've established the factors at play, what's leading to crude all the way up to 80. But when we come back, I'm going to ask our experts, the panelists, to stick their neck out and try and envisage what's the range that we could see for crude in both the short term as well as the long term. Is there more upside to this $80 per barrel mark? That coming up after this very quick break. Welcome back. You're watching Oil on the Boil, a special edition, considering Brent is already at $80 to a barrel. In conversation with my panelists, Fatih Birol from IEA, Michael Barry from FGE London, Jonathan Bharat from IS Alliance, and Vandana Hari from Vanda Insights. We've established the factors at play, why crude is bobbing its head above that $80 per barrel mark. But let's try and figure out where is crude headed next. And Michael, if I could come to you, and the reason that I ask you this is because it's almost a tug of war out there. Because Saudi, because of the upcoming Aramco IPO, wants $100 to a barrel as pricing. Iran, on the other hand, is pushing for 60 to 65. You think US production growth will let Saudis off the hook once again?
That's right. There's been some rumours that they may even want $100 a barrel, or are thinking about it, though we actually think that would be too high. Yes, Iran, I think, is arguing for a lower price of maybe 60 to 65, but they really don't have any clout, particularly now. So I think the Saudis can almost do what they like. The other main factor in all this, though, is that the US oil production is still growing very, very fast. In fact, we've just raised our forecast for US output in the next year or two. And we see actually growth in US output of about 1.8 million BD next year, which is phenomenal. Now, that would actually offset a lot of the losses we're talking about from Venezuela and Iran. So our view is that we don't see Saudi Arabia and the other Gulf Arab countries having to raise output very much to cover the losses from Iran. We think only maybe a few 100,000 BD. And then they still have spare capacity above that. So our view is they have the option of keeping the price pretty well where it is now if they want to do that, or at least stop it going too high.
Fatih, but how much of this price rise is because of genuine demand fundamentals, and how much would you say is because of speculative positioning of global hedge funds?
It is difficult to quantify how much this, how much that, but I can tell you that currently fundamentals are definitely driving the numbers. The not enough supply from the major producers, strong oil demand growth, and also Venezuela is going down the production substantially, are the key drivers of the tight markets today.
But Fatih, do you see shale gas and shale oil drilling also catching up with these high oil prices? And also there is a lot of talk about electric vehicles, you know, across the world. How is that going to impact oil prices in the near future?
Yes, shale oil from United States will definitely will be comforting the markets, and also electric cars coming from different countries may also make a change, but this is very, very small. I know that your country, India, takes electric cars very seriously, but when we look at the immediate challenge in front of us in the next few years to come, I wouldn't expect that the electric vehicles could change the picture dramatically in this market environment. But when we talk about the challenges, I should also mention that India met a major challenge recently. On 28th of April 2018, this year, Prime Minister Modi announced that all the villages in India have now access to electricity. I can tell you, I study the global energy every day, every month with my colleagues here. I can tell you that this is a historical achievement, and all Indians should be happy and proud of this historical achievement that all Indian villages now have access to electricity. I think it's not only good news for India, but as such, India can be a source of inspiration for many around the world, including Africa.
Michael, from an investment perspective, could we see a scenario where higher allocations are now made to commodities versus equities? Liquidity sees a shift, as rare as it may be, but given the extremely bullish crude scenario right now, are net longs likely to race ahead?
Yes, it's possible. I think there has been some movement already. And everyone is getting very bullish about oil. So it is possible we could see some more of that trend developing. I mean, in our view, it's very difficult to see anything that's bearish at the moment for oil. Even if oil demand got weaker, we think that's a relatively small factor compared with all the bullish factors that are out there at the moment.
So, Michael, I'm going to ask you to stick your neck out. Closing comments. Where is it that you see crude headed in the next 6 to 8 months? And what could be the possible upside and downside risks to your forecast?
Well, we're working on a forecast of $75 to $85 a barrel for the next 6 to 9 months. Though I have to say, there is a risk to the upside more than the downside. If Venezuela completely collapses, you know, there is the risk of a higher price rise if the Saudis and others are slow to react. Because the dilemma the Saudis have, of course, is they don't want to raise production too much and see the price trending down again. So they've already said this. They're going to take a very cautious approach and wait and see. So we think they might be reactive rather than acting ahead of any price spike. But barring any major problem like that, we think we're in a fairly stable range, maybe of $75 to $85 a barrel.
Vandana, history is proof that oil prices have proven consistently unpredictable because of the various political, geopolitical, economic trends and events affecting the supply and demand for oil. But where is it that you see prices headed from the $80 per barrel mark?
At this point in time, given the combination of factors that we do know, the known unknowns included, it doesn't look like there are very many factors on the horizon that could weaken oil prices. All the signs currently point to prices remaining at well supported at current levels, I would say, and possibly or probably rather going higher from here, because one of the biggest hurdles that needs to be crossed in the coming months is with regard to Iran supplies. What actually happens with the US sanctions, to what extent countries start pulling back on their purchases from Iran. It's difficult to say exactly how many barrels would be removed. But
okay. Jonathan, some analysts are saying that OPEC itself is quite divided. Iran is comfortable with 60, 65, though with US now ditching the new deal, it's been ignored, while countries like Saudi are looking at $100 to a barrel in the run-up to the Aramco IPO. Where do you think crude is going to settle in the near term?
Look, I think when you've got, obviously those discussion points there, if we go back to what OPEC and what OPEC are actually doing, remember OPEC actually supplying more than they said they should be supplying. I think people always want this balanced price for crude, and I think that the question will be, particularly on OPEC, well, now that this glut's out of the way, what are you going to do? What are you going to do? You're going to ease those supply restrictions? Are you going to sort of allow more to flow? What are the other reasons why you're not going to be there? Because at the end of the day, that would be very unfair to the market. And I think OPEC, in my mind, will be saying, well, look, we've reached these areas. We're no longer a supply glut. We've got good prices. So therefore, we should ease that supply and put that 1.8 million barrels or some of it back into the market. I think given that where we are at with the prices, I would think that, maybe 85 is probably the top. Let's see what the Iran situation occurs. Let's see more news about that. But generally, I don't think prices should be up around these levels for too much longer.
Well, in the near term, all that one can say is it's the most uncertain story on the street right now. Crude prices, with it already at 80, and most of our experts do seem to believe that as much as they would consolidate, there are upside risks to all of their estimates in crude. And 70 to 85 seems like is a level that we will have to live with when it comes to Brent prices. But Vandana Hari, Fatih Birol, Michael Barry and Jonathan Bharat, pleasure speaking with all of you. Thank you so much for taking the time out.